All right, let's do this. Hi, everyone. We have Rob with us today, and Rob is the co-founder and CEO of Clearpool. Clearpool is one of the more exciting DeFi projects out there, but because of the way it is building stuff in DeFi, it's not that easy for everyone to understand. A lot of people within our community have been asking, like especially people who are new to DeFi, what's Clearpool really doing? What's happening with it? And trying to understand the whole gambit of DeFi and the role of Clearpool within it. So, Rob, it's so great to have you with us today, and would love to start understanding from you to begin with as to what's happening in the DeFi space right now, and how do you visualize it, and how do you define it for a layman?
Yeah, well, thanks, Shash. It's great to be here. So right now, DeFi is clearly, is experiencing, explosive growth, and I think, people within this space already realize, the potential that it has, but it's also now making waves, really outside of crypto, and starting to sort of get the attention of, more sort of traditional financial institutions as well. And I think the main thing here is that, what people are realizing is the potential for disintermediation. People know now that, in the traditional world, financial services are effectively controlled by, large institutions, and it's very difficult, to do anything outside of that space. And you're essentially forced, to use these companies, and it can be expensive, and it's decades old infrastructure, so it can be slow and clunky. And
besides banks, is there an example you can give us of these companies?
Well, yeah, so I think, anything really. I mean, we're kind of forced to use banks right now. I mean, you can't really do much, if you don't have a bank account. But of course, there are many people in the world who are unbanked, and DeFi is a way for them to get in. But, I think really anything that involves money, it's very difficult, to do anything, or it has been very difficult to do anything up until now. So we had sort of like the fintech movement, which tried to do that, but ultimately what happened there is that the banks kind of bought those businesses, bought them out, and tried to integrate them into their own operations. They just remained in control of the entire thing. But with DeFi, the majority of it is fully decentralized. It's you're dealing with a DAO, so it's very difficult for a bank to come in and buy that DAO, right? It's virtually impossible. So I think people now realize that these new solutions to the problems that fintech was trying to solve can remain and continue into the future and help more people get access to financial services, but on a level playing field. And that's kind of what Clearpool is all about, really. So essentially, there's some kind of like buzzwords, that are used in our marketing, but essentially, all it is a way for institutions to borrow money without having to use any collateral up front. So that's unsecured liquidity. But they're basically they can do that and attract that liquidity directly from the DeFi ecosystem, which eventually we think can be pretty much everyone. So right now, in the traditional world, institutions will borrow capital, from a bank or from a number of banks. Those banks will then wrap that product or securitize it, and then it goes through a process, and then eventually, if you and me want to get exposure to the yield that debt provides, by the time we get to do that, it's gone through such a long process and such an expensive process that actually a lot of the value is taken away, and it's expensive then for us to be able to try to get a piece of that, right? Especially if you're.
I hear you. I understand like 20% of what you're telling me right now. It's complicated, right? I don't come from a finance background. I kind of do understand what you're trying to do here, but I need some examples of how this will come in, how this is coming into play, because people are clearly getting it. Like the tokens performing really well, products are coming out, there is institutional interest. And seems like you're getting retail interest also. So where do these stakeholders sort of fall into place here? And can you give me some names and examples of how this ecosystem is kind of forming as of now?
Yeah, sure. So today we'll announce one of the first borrowers on the platform. It's Amber Group, right? So Amber is a big player in crypto. You know, they're a huge market maker, and they have massive volumes. I think anybody in crypto, you know, knows this name. They know what these guys do. You know, they have a huge reputation, and on Clearpool, you will be able to lend directly to Amber. There'll be nobody in the middle. There'll be nobody in the middle to take any fees on that. So whatever interest rate the Amber pool is offering, you will get all of that, right? So you can lend to Amber. You know, you trust Amber, you like their strategy. You know, you can see everything is very transparent. You can see what they do, how they use the capital, you know, how much risk they're taking is all on chain. So on Clearpool, you can lend directly to Amber. So if the Amber pool is paying 10%, and you like Amber as a company, and you want to lend to Amber for any period of time, you can put your money into that pool. The pool will give you back CP tokens. CP tokens represent the liquidity that you've provided to the pool, and they accrue the interest for that pool. So you can leave your money in there for as long as you want or as little as you want. When you're ready to take it out, you redeem the CP tokens, you get back your original liquidity plus the interest. But during that time that you've been holding the CP tokens, you can also stake them to earn additional rewards in the CPool token. So even though the Amber pool was paying 10%, that comes directly from Amber, overall your APY could be more like 20 or 30% because you stake the CP tokens and earn the CPool tokens on top of that. So it's a very attractive way to gain exposure to the companies that you like, that you trust, but also get, you know, a huge reward for lending to them in this unsecured way.
Couple of things here. What is the current APY on staking CPool tokens?
So CPool at the moment is 100% APY. So you can stake them on KuCoin, on Gate, and on Ascendex. We have the single token staking on all three of those exchanges. And we've set that at 100% initially because our protocol hasn't launched yet, and we're building our community. So we have a lot of early community members who are, you know, are really passionate about what we're doing, and you know, we want to reward them during this time for being there for us, for telling people about what we're doing. So this 100% APY is our way of saying, you know, thank you for being there, an early member of our community.
And since when have you been paying this 100% APY?
That's been since we launched the token, which was on the 28th of October. And it's currently been extended to the end of the year. So that'll be there until the end of 2021. And then Clearpool V1 will be launched on the mainnet in January. So we'll try to extend the staking right up until the point that we launch. And then, of course, people will then be able to actually provide liquidity into the live pools, but still be able to earn attractive CPool rewards by staking the LP tokens at that point.
So the company right now that is taking funds from retail as of now, what do they intend to do with these funds that they're giving 10% interest as of now?
So the borrowers?
Yeah.
Yeah. So mainly the borrowers crypto native. So they're kind of like they're trading firms, right? So they're trading desks or they're crypto hedge funds, market makers. So, you know, they need liquidity because to be able to execute their strategies, it can be quite capital intensive, right? So if they want to have, you know, a certain position here where they're long something, they have an option here, or they're short futures over there, they need liquidity to be able to maintain those positions and to effectively execute their strategy. And these guys are very, very successful. You know, they have huge returns, but they need capital to be able to generate those returns. So as a lender, what you are effectively doing is being a part of that. So you are kind of, getting your piece of the returns that they are making in the market, right? So,
but also the tables have turned now. Like what I like about this is that so far everybody was borrowing, right? The retail had been a borrower so far. So we take the risk and the lenders have zero risk. Basically, that's what has been happening so far, because you have the staking mechanisms and you can add, your USDT, BTC, ETH, etc., and earn APYs on it. But most of the times we were not aware of what these companies are doing with it or who we are giving it to. We're just giving it to a Nexo or a Binance or a BlockFi or one of these organizations. They're all centralized in their nature when it comes to this particular activity. But now you're saying what we can do is, in a transparent manner, start loaning money to these companies, exactly know what they're doing. In fact, then these guys will fight amongst themselves within your platform as to who's going to give a higher APY. But the risk is not on the lender anymore because it's on them. So in case they were to get liquidated because of taking a risky position, my money is still secure, my APY is still secure. Is that correct?
Kind of. So there's still risk because this is unsecured, right? So you're lending your money to them. If they go out of business and they don't repay, that's the risk that you're taking. That is essentially counterparty risk, right? So let's rewind a little bit. Let's rewind. So when you lend to Compound or Aave, there's very little risk because when somebody borrows from that pool, they also have to be lending as well, right? And they actually have to lend more than they borrow. So it's over-collateralized. So if somebody doesn't repay, they hit the liquidation ratio, the collateral gets liquidated, and everyone is made whole. So it's kind of risk-free. Here, what we're saying is we're solving that problem of over-collateralization for the borrowers. So now borrowers can borrow without having to put up collateral. And we're transferring that risk to the lender. So it's actually kind of the opposite to what you said. However, what this means is that the lenders can now get access to the opportunity, right? So here we're lending, to huge market makers. They have, they're very successful. They're very reputable. They're very transparent. They need liquidity to execute their strategy. The strategies in many instances are risk neutral, right? So there's actually not a lot of risk being taken with the collateral. They just need it to be able to execute their strategy. So you're lending to them unsecured. So you do have the risk of the counterparty defaulting. But the way that Clearpool liquidity pools work is that the rate of interest increases with the rate of utilization, right? So when the borrower is utilizing more of the liquidity that's in the pool, the interest rate goes up. So essentially you're getting rewarded as the risk increases. So as I mentioned earlier, these guys, they have, really, incredible returns, over the last few years. Very, very, very strong returns, and you can now lend to them and get a piece of that action. Whereas in the traditional world, if you wanted to go, rewind, years, and you wanted to lend money to a hedge fund because the hedge fund has been outperforming, over a period of years, it's very difficult as a retail investor to get a piece of that market. It was virtually impossible for anybody to ever really, to get involved in that, to basically invest and get a piece of those returns. Now with Clearpool, you can lend to these guys and you can enjoy the that part of the outperformance yourself.
I'm sure you must have been calculating what are these numbers that we can expect from some of these borrowers, in your opinion? How much can one look at?
Well, so it will vary, and like I say, it depends on utilization. So if the pool has a very low utilization, the interest rate will be quite low. But if it's a high name, a very reputable borrower, then maybe people are quite happy to lend to them at, let's say, low single digits or mid single digits, 5-6%, something like that. And if that's the case, then that borrower will be able to continue borrowing at this level, right? More money will come into the pool. As the money comes into the pool, the interest rate drops. But then he can borrow more, interest rate comes back up, attracts more capital, and you have this equilibrium effect. As they start to borrow more, the interest rate goes up. So really, it can be anything between, for the pool itself, it can be anything from sort of like, I would say, mid single digits right up to 25-30% from the pool. But then that will be enhanced with the opportunity to stake the CP tokens and get the CPool rewards, which in the beginning will be very attractive because we have this rewards mechanism that tapers off over a long period of time. So the overall APY for lending on Clearpool, in the beginning could be, anything around sort of like 40-50%, which is very attractive. And so the good thing is that, as a lender, that you're getting a risk adjusted return. So as the risk goes up, you earn more. As the risk comes down, you earn less. And that's basically
correct.
The beauty of it.
Correct. And that's why we're kind of banking on their ability to make sure that they give us the returns is the reason why we're giving them unsecured loans in the first place. Because as of now in the market, you can get somewhere between 14 to 16% on your USDT in a very secured manner, whether it's like a Nexo or a Crypto.com or any of these guys, they're giving that. And I feel far more secure there. The only reason I would give it to one of the borrowers on Clearpool is because I'm feeling I will make more money. I'm hoping 30%, 40%, 50% returns. Because if I'm getting 15 on a centralized ecosystem with far more surety that they're insured, they have all these things, I want more returns. The CPool part I'm more excited about. That staking is pretty good. But I think you will have these borrowers sort of fighting amongst themselves, trying to give more to the lenders to get more liquidity in their platforms as well.
Absolutely. The entire thing is driven by the market forces of supply and demand, right? So you've hit the nail on the head with that. So you will have that, So we many of the borrowers are kind of going to be very similar companies, right? And they're all competing for liquidity. So if somebody's paying 10%, the other guy is like, well, I'm going to need to have a higher utilization rate, so I'm paying 12% so that I can I attract the liquidity. So in a way, that equilibrium effect is going to rise with that competition for liquidity. So you will definitely see that dynamic play out. When we launch. So yeah, I think it's very exciting, to see how that will play out. But ultimately, from a lender's perspective, that's what you want to see. But you also know that you can enhance your rewards by staking the CP tokens during your participation, and that's really where the higher APYs will come from, and that's what's going to attract not just institutional liquidity, but it's going to be attractive for retail as well.
Is there a lock-in period if I go give this unsecured loan to one of these companies? Is there a lock-in period that I need to know?
No. So you can redeem at any time. So you can lend one day and redeem the next day. There's no penalty for that. The only thing is that you'll only be able to redeem if there's liquidity available in the pool. So if the pool has very high utilization, it's going to be paying a very high interest rate. The chances is that more liquidity is going to flow into the pool because the rate is so good. So there will be opportunities to redeem. But if you have a situation where there's no liquidity available in the pool because it's fully utilized, you'll then be able to trade those CP tokens in a secondary market. So there will be demand for that pool. If that pool is being very well managed at a high utilization rate, there'll be liquidity providers that want to get access to that return, that exposure to that. So you'll be able to sell those tokens in the secondary market, and you might get more than 100%, right? So this is the same as what happens in traditional fixed income markets. Excuse me. In the bond market, for example, bonds often trade at more than 100% of the par value.
Right.
And that's what will happen with CP tokens. They might trade the other way as well. They might be at a discount, but you will be able to trade them in a secondary market. And eventually you'll be able to do a lot more with those tokens as well. So for example, the CB tokens can be stripped into the yield component and the underlying component. So running parallels to traditional finance, this is what you would call coupon stripping. And what it means is that you can monetize the yield element up front. You can just trade that part. And then we'll also introduce some credit derivatives. And I know, again, this might be terms that some users might not really be familiar with. But essentially what this means is that what we're doing here is giving lenders more optionality in terms of risk management. So how can I've made this investment, if you like, I'm lending to this company. I'm happy with it, but I want to manage my risk. I want to hedge my risk. I don't want to have a situation where I'm sleeping, where something happens and I lose my money. So we'll introduce these ways where people can do that. And that's not just going to that's going to help LPs of all types, but it's going to attract more lender profiles into this space, because right now, TradFi lenders aren't really playing that much in DeFi because it's very difficult for them to take that step. They don't really have any risk management tools, and that's what they really need to see, to be able to sort of satisfy their risk teams, that they're able to to take advantage of this arbitrage opportunity that exists. The returns in DeFi are much higher, but they don't have the opportunity, to hedge the risk that they're taking. So with Clearpool introducing these types of credit derivatives and risk management tools, it's going to attract more lender profiles into this space, but also more borrower profiles as well. Because as a borrower, that you can issue debt in the real world and pay 5%. You can issue the same debt in DeFi and pay 5%, but that return is also being subsidized by the platform itself. So it's actually, let's say, a 10 or 20% return. So as a lender, you'd much happier lend to the same company in DeFi and get the higher reward. So it's going to attract, not just more lender profiles, but more borrower profiles. And that means that, we can really, see explosive growth, in a short space of time. And this is very good for CPool holders, because in order to do all of this, of course, you have to be holding the token or staking the token. And that's obviously going to be good for the value and the utility of that over time. Not to mention, of course, that we'll, as a decentralized protocol, Clearpool will always be in the market buying back the CPool token to sustain the reward pools, so that we can continue to pay those rewards into perpetuity.
Talking about the CPool token utility and dynamics within the ecosystem, and also like other tokens as well, what do people invest in with? Is it just USDT, or is it USDT, ETH, BTC, CPool? How does one invest?
So,
lend.
Yeah. So to begin with, we've been developing with USDC, and it's the majority of the borrowers need to borrow in stable coins, right? So this is really where the demand is right now. Anyway, we will probably shortly after we launch we're definitely going to introduce more stable coins. We're actually going to we're developing on Ethereum. We'll announce soon layer 2 support, but then we'll also announce which blockchains we're going to build on next, and that'll mean that we'll be then we'll have pools in various different stablecoins on different chains. So again, this will attract liquidity from other parts of the ecosystem which at the moment, if you just develop on one chain, you might not be able to get access to that. So in the beginning, it will be USDC right at the very beginning, but shortly after, you'll see many different stable coins supported. But it's also possible that you could have pools in other assets such as Bitcoin or Ethereum or the wrapped tokens as well.
Yeah, that's pretty fascinating. One of the things that suddenly came to my head is I've always been thinking cross-chain is pretty fascinating, but the first thing that needs to get cross-chain is stable coins. Like basically, you should be able to move your USDT, USDC very easily, right? With what you're trying to build here, maybe not a prima facie use case, but it is a possibility of having a pool of stable coins that people can simply swap from one chain to the other. And that's like possible as well, because I want to invest in somebody who's accepting BUSD on Binance chain, but I have USDT or USDC for that matter. I can clearly add it to the pool, and there is liquidity enough to go because you will be having the full pool of liquidity in various chains as well.
Yes, exactly.
But I'm not sure.
Yeah. So that's really where we want to be. We want to really be cross-chain, multi-chain project. That's been our intention from the very beginning. Ethereum was the most logical place for us to start, as with a lot of other projects. But it's really, been our intention from the beginning. We already have actually, many conversations with other chains, and we're actually already, in discussions, to announce, which chain we'll build on next. And as I mentioned, the layer 2 as well. So we'll be making those announcements before we launch on the mainnet, and people will really then be able to see, how that picture is going to emerge, and Clearpool is definitely, going to be one of the first protocols in this space, to be truly cross-chain.
I think it's not very hard to speculate on the fact that the most amount of liquidity is on Binance Smart Chain, and it'll make perfect sense for you guys to move there. But I'm pretty sure that's not the topic of the current conversation.
Well, we've got many conversations ongoing, so it's exciting because all of them, very supportive of what we're doing. They see the opportunity, and I think eventually, we really want to be supporting, all of them. And of course, it's not possible right at the very beginning. But we're very excited to at the prospect of being able to do that.
Coming back though, so it's USDC right now on ETH. I put in my USDC. The lender gets USDC from the pool as much as they want, and then the interest rate keeps fluctuating. There is a base interest rate, like I at least get 10%. And then it could go more and more as more and more money is being pulled from the pool that I'm a part of. But as a lieu of me giving this money, because it's an unsecured loan, I am given CPool tokens as collateral to keep. How does this work? Where does the CPool token come into place?
So the CPool is additional rewards. So as you've lent USDC into the pool, and you've received CP tokens in return, right? So don't confuse CP tokens with CPool tokens. They're dead.
Got it.
So CP tokens are the LP token.
Liquidity pool.
Yeah. So that represents the liquidity that you've supplied to the pool. It accrues the interest rate for the pool.
Got it.
And it also represents the risk profile of the borrower of that pool. So they're your LP tokens. Now you will stake those LP tokens to get the additional CPool rewards. So you can go from, let's say the pool is paying 10% interest. You can go from 10% to earning 30% just simply by staking those tokens and getting your additional CPool rewards. If you want to redeem your CP tokens to get back your original liquidity and the interest, you have to unstake, and then the CPool tokens go back into the CP tokens go back into the pool, and you redeem. So it's a very simple process. It's literally like a one-click solution on the app. Once you've received them, you click stake, and then you boost your rewards. So it's from an LP perspective, it's going to be very, very, very simple. You will connect to the app, using a wallet such as MetaMask. You'll see all of the pools that are available. You can see exactly how much each one is paying. What is the borrower profile? All of that information is there. You select the pool, you provide liquidity, you stake the tokens. It's very simple. Next thing you know, you're earning 30-40%. You leave it there as long as you want. When you're ready to redeem, you just do the reverse process. It's very simple.
Fascinating. Yeah, this is extremely interesting. Simple, but so needed, so necessary, and I think it's very well thought out as well. I think you must have looked at a lot of projects and seen what's happening in the space before kind of solving this particular issue. Are there any interesting projects in the space right now that you kind of find interesting, and some things going under the radar would be interesting for the community to hear, something that you like?
Well, the one that excites us, a lot right now is our partnership with X Margin. X Margin they're kind of like the leaders in credit scoring, on-chain credit scoring, right? So what they do is they take like on-chain data from all of the borrowers, as well as some off-chain data as well, and they use that data. They have some risk engines. They compute multiple risk metrics to basically generate a credit score, a risk score for that borrower. And this is done in real time, and it's done using zero knowledge proof technology. So essentially, they can take as long as they've got the read-only API keys from the borrower, from all of the exchanges that they execute their strategy on. X Margin can take all of that data, run it through their systems, compute all of the risk metrics, and build this credit score. But they can do that without actually having to see any of the positions that the borrower is taking, or any trading strategy, so that the privacy is preserved from a borrower's perspective. But from a lender's perspective, you can see a real-time risk score, or basically you can see exactly how much risk that borrower is taking at any point in time with the liquidity that is being lent to them. So this is really, really cool feature that we have on Clearpool. We've partnered with X Margin, and they will be providing that for us. So again, as you go into the app and you see all of these pools, or all the different borrower pools, you can also see the risk score for each one. So you can see which ones are taking more risk, which ones are taking less risk, how that has changed over time. And that's something that you don't get in traditional markets, right? You don't have the ability to be able to sort of have that transparency, and to see how much risk the borrower is taking at any point in time. You just have like a sort of a generic risk score, which kind of stays the same for a much longer period of time, and it doesn't really give you that sort of granularity and that visibility. So that's what something that DeFi and the technology that X Margin has developed allows. So that's a really cool partnership, and as you said, it goes under the radar because it's not something that people think about. How much is like the risk element of it, right?
Right.
But to be able to see that, I think, is very, very important, and this also allows us, to build these other things that I was talking about, these risk management tools, derivatives, and that again is just coming back to being able to attract more profiles into this space. Once you have that in place, you're going to get a lot more attention from sort of traditional institutions, and that's where the growth is going to come from. So I think our partnership with X Margin is a really interesting one. There's a few other projects.
Are they a token? Do they have a token?
They don't have a token. No, they don't have a token. We have some investors in common. So, in fact, we did a webinar yesterday with X Margin and with HUGE Capital and Wintermute. They're both investors in both projects, Clearpool and X Margin. Right. But they don't have a token. It's not a token project. For us, I think we're really focused on what we're doing. There are some other projects out there that kind of providing a solution to over-collateralization and offering, uncollateralized loans or under-collateralized loans. But I think Clearpool is really the main differentiator is the fact that we have the single borrower pools, and on the back of that, then we can create this like concept of tokenized credit, and then all of the risk management stuff that comes on the back of that. And as I said, that's really gonna put us in a position where we can attract the growth potential from TradFi into DeFi.
Fascinating. I think it was really, really nice to speak with you, Rob. Appreciate your time. Learned a lot about Clearpool. I think what you're building is not very well understood yet. And I think it'll be very interesting when people hear this particular interview and find out more about what you're doing at Clearpool as well.
Yeah, no, it's been a pleasure to be here, and it's our job to try to to make it easier for people to understand. It's like I tried to say at the beginning, it's actually quite simple, but I guess we need to do more of these interviews to get the word out there, and because it's going to be very, very exciting, for people to get involved in what we're doing.
Awesome. Thanks again.
No worries. Thanks for having me. Thanks, Shash.